Hello, everybody, and welcome to the show today. I'm really glad everybody could join us. So today we're going to be diving in. We're going to be talking about venture capital, what it is, how to get it, venture capitalists, what they do, a little bit of the difference between angel investing, basically everything you need to know to be able to get venture capital for your business. Now, during today's presentation, I will be talking about a link, creditsuite.com/get funding. If you ever need help with getting any kind of financing, check out that link, creditsuite.com/get funding. We never charge you a dime to get money. Of course, lenders and people that issue credit lines, et cetera, often will have points and rates, but we negotiate that for you. And we deal with all the kind of financing that we talk about so we can help you get the most amount of options to be able to get the most amount of money for your business. For those of you who don't know me, my name is Ty Crandall. I'm actually the CEO here at Credit Suite. If you have any questions along the way, feel free to give us a call, 877-600-2487, or send us an email, info@creditsuite.com. Also, if you're watching on YouTube, if you like our content, like and subscribe. That way you'll get notified every week when we go live here on YouTube. And if you're listening on iTunes, leave us a quick review. Let us know how we're doing so we know the kind of content to be able to continue to deliver to you so you can listen on the go. So when we talk about business financing, we're basically talking about getting the working capital you need to grow, and it doesn't have to be really hard to do. So whenever you hear we talk about working capital, that's just basically a phrase that we use in the lending space to refer to as money you can use for just about any purpose. So a lot of businesses these days are turning to venture capitalists, probably more than we've ever seen before in the past. And these options can work really well for startup ventures as well, although startups typically gravitate towards angel investors, and then companies that actually have a viable product to hit the market usually gears towards venture capital. There's still a lot of venture capital available, even if you're a newer business. But there's a lot of details you should know, which is why we're diving into today. We've got a lot of questions about how venture capital works, and that's why I wanted to kind of jump in today and decode all this for you. So what is a venture capitalist? Well, according to Investopedia, a venture capitalist is an investor who either provides capital to startup ventures or supports small companies that wish to expand but do not have access to equity markets. Venture capitalists are willing to invest in such companies because they can earn a massive return on their investment if these companies are a success. And that's interesting because if they are a success is really what it comes down to. When I look at angel investing in venture capital, it's pretty simple. They take the risk that most lenders won't take. It's that simple. Conventional banks, even alternative lenders, will not lend to a lot of businesses that angel investors and venture capitalists will. And there's a reason for that, because what these guys are looking for is home runs. They are looking for the Ubers of the world, the Airbnb of the world, the companies that all of a sudden make them hundreds of percents of return on their initial investment. But they also know that only about 10 or maybe 20% of who they invest in will actually succeed. They know going in that 80 or 90% of these are going to fail, and they're banking on these huge successes to be able to make their money. So again, if any lender lent money knowing that 8 or 9 out of 10 people would default, they would never lend money. But these are risks that only these type of private investor individuals will really typically dive into and take. So venture capitalists will give money to help build new startups if the VCs believe a company has both high growth and high risk potential. So again, we come back to that same point. They have to see that you have the ability to not just grow, but grow really fast. And they also want you to be high risk, because if you're high risk, you're not going to lenders to get money. You're going to need to be in a position where you're going to have to exchange equity in return. And again, the higher the risk, typically the higher the return, the higher the reward. So this tends to be fast growth companies with an exit strategy already in place. We're already talking about some important buzzwords here. Exit strategy. You need to know going in that venture capitalists and angel investors want to have an exit plan. They want to know you're going to get out, what you're going to do to get out, either sell or typically go an IPO, go public, and they want it to be done in a pretty short time period. Most of these guys are wanting you to do this within about 3 to 5 years. And about 3 to 5 years, they're going to want you to grow to the point, to business to a point where you're possibly getting other investment to continue the growth, or you're selling, or you are going actual public at that point in time. So again, 3 to 5 year time frame is what they're really looking for, and they'll often want to own a larger piece of the company, if not a controlling stake. This isn't uncommon. How much experience do you have? How much money have you put in? Where are you in the project? Those are going to determine the kind of equity stake that venture capitalists are going to take. Is there other people involved? Is there other angels involved? These are the things that they're going to want to know. But it's not uncommon when you start to get into fundraising to get into the potential to build 100 million or billion-dollar companies. But the problem is that you're typically going to have to give away larger stakes of the business, which if it's a billion-dollar company and you have 50% ownership, that's still pretty good. But again, you're going to have to give up these larger percentages to attract these kind of investors. So people like Jeff Clavier do both, okay, probably depending on the amount of risk and the expected amount of return. So Jeff Clavier is one of the biggest, most well-known venture capitalists out there. And again, what they're really looking for is to make sure that they can have a large piece of the business and a high potential of return. So again, Clavier is the most prolific angel investor of all time. And he's also a venture capitalist. So he deals with both of those actual spaces. So who are well-known venture capitalists? Well, apart from Clavier, other known well-known ones are Facebook's first investor, Jeremy Levine, okay, also known as Pinterest's largest investor, early Facebook investor Jem Breyer, okay, Twitter investor Peter Fenton, okay, PayPal's founder Peter Thielen. Okay, so these are some of the best well-known venture capitalists out there. And again, you know, when you look at these, a lot of them invested into multiple of these. Uber's, Twitter, they were around in a lot of these early type of tech startups in the beginning. Chris Sacca, an early investor in both Twitter and Uber. So Chris, you see on Shark Tank. If you ever watch Shark Tank, you see him. And it's pretty interesting. You know, I read a great book on angel investing where it talks about Chris. And what he used to have was these big powwows in this house where he would have a house and all these people that were these tech startups would be able to go to it and just discuss strategy. They would just basically have what they called jam sessions. And these jam sessions, they would just jam out these ideas. Okay, Uber was there as well. Okay, so Uber's founders were actually part of these jam sessions. So Chris got in on Twitter and Uber and a lot of other investments just by having these jam sessions, pulling together a lot of really new businesses in the tech space and then kind of cherry picking the ones that he felt had the best potential. So how does someone become a venture capitalist? So one path is via tech-oriented investment banking. The other more common method is through serial entrepreneurships, meaning a lot of these people have already been there, right? A lot of these people already owned businesses. They exited the business. They sold. They went public. They took their money and they reinvested the money into other ventures, right? And we see this more predominantly now than we ever have. When we look at Amazon, when we look at, Bezos, and we look at, these other co-founders like Elon Musk, we see that these guys are doing the same thing, right? They're taking their money out of investments that they made a lot in and companies they sold, and then they're putting it all into these other ventures, okay? And that's what Musk did a lot with, I think he was PayPal originally in the beginning, where again, he's taken the money from one endeavor as a serial entrepreneur and then putting it into multiple different business ventures and reinvesting nearly all of the money into other business ventures. So this is a person with a company or companies backed by VCs typically that they're coming from and is more likely to eventually become a VC. So people that understand the process from the other end. Okay, these are entrepreneurs who built successful businesses. They got venture capital. They understand how the process works. Then they sold or exited or went public. Now they're out. Now they're taking money and investing it the same way from the other side of the venture capital transaction. So venture capital was fairly new. It goes back to about World War II. Before that, companies would have wealthy backers. Those were the Vanderbilts, the Rockefellers, the really, really, really rich, rare billionaires of the world, or $100 million plus people of the world. Venture capitalism mean new companies didn't have to get backed by old money. Okay, and that's really what it came down to. Is there used to just be a handful of these really, really, really big, very, very, very rich entrepreneurs. Remember, this was before being a billionaire was chic, right? Now being a billionaire is a chic. You're the end person. Then you were just kind of treated almost badly because you had so much money that you didn't know what to do with it. Well, that was a lot of who was investing in these companies. These, 5, 10 people that were the richest ones out there were the ones investing before venture capital. And then venture capital came around and it gave you a chance and me a chance, right? The businesses that aren't the runaway hits maybe still to be hugely successful with venture capital. So Fairchild Semiconductor was the first startup backed with venture capital. They were founded back in 1957, funded in 1959, and at the time, VCs would set up limited partnerships to even hold investments, okay, where professionals would act as general partners. Anyone supplying capital would be passive partners with limited control. So a lot of stuff is changed for sure. But again, that even now, this is kind of the way that it is again, the venture capitalist takes an ownership, they take a partner type of position in the business. And what you'll learn about venture capitalists is a lot of them want to be actively involved in helping you grow the business. They want to sit on your board. They want to help guide you, while other venture capitalists just don't really care as much. They don't really feel a need to be as big of a part of it. And also, that's a big difference with angel investing as well. Angel investing, they kind of tend to give the money, don't really care as much about being on the board, and don't tend to be actively involved with helping you run the business. Venture capitalists are putting a lot more money, and they're putting millions in sometimes, whereas angels are sometimes putting in 10 to 50 grand. So they have more at stake and want to sit on the board, want to have more of a controlling interest. So venture capitalists are looking for a bunch of different things if this is a strategy that you're looking at to get money. First, a strong management team. They're going to want to see resumes. They're going to want to know the experience of the people that they're actually investing in. As a matter of fact, a lot of venture capitalists out there, including Chris Sacca, will really promote that they're looking more for the individual that is building the company than the company itself. Okay, so they're looking for a strong management team, people that have experience in the industry that they're in, people that maybe even have experience in growing, scaling, and exiting a business. If you have that, you're going to be highly sought out or looked at more favorably from these type of investors. If not, just the fact that showing that you have the knowledge and experience to run a business, or even showing that you have a ton of experience and knowledge in the field, any of those things can be strengths they're looking for. They're looking for a large potential market. So what that means is they're looking for something that can go be sold to a bunch of different people. So let me give you an example. Okay, a buddy of mine, a friend of a friend, had a chance to invest into Yeti. And they passed on investing into Yeti because Yeti hadn't figured out their market yet. They were still trying to kind of gear their market towards this small group of outdoor sportsmen. Okay, now we know Yeti's everywhere. Every common people are using Yeti, even that aren't outdoor sportsmen. But in the beginning, their market was too small. The outdoor sportsman market was too small for them to have an interest in investing. They saw a small market and an expensive high-end product, and they didn't think that those two were going to sell as much as they did. Yeti figured that out. Yeti then, because in large part of these venture capitalist meetings and that objection, found a way to get mass market appeal for their product, and that's how they've become as successful as they are, because now they appeal to a large potential market, even the people that aren't outdoor sportsmen, for example. So the largest group of people you can serve, meaning the more people that are out there as potential buyers of your product, the better off you're going to be. And they're also looking for a unique product or service. Okay. Ultimately, they're looking for something that is different, not you're going out and doing something that somebody else is doing. They want something that's completely unique, something that's different, something that solves a big problem. So it's interesting because when you look in to the founder stories of companies like Uber, what you find is that these big giant leaps forward happen typically when something changes in the world to make a new product available. So for example, with Uber, it was actual navigation, right? We didn't have GPS, but when GPS hit the scene, that's how Uber became successful, because all of a sudden everybody had GPS on their phone. And that's what created an environment where Uber could become Uber, right? Uber was never possible before because everybody didn't have GPS on their phones. It was the changing of the space and technology where GPS became available that Uber then became available. It became a viable product. So when you read about angel investing or read about companies like Uber or these projects, that's what you find is that they have a unique product or service, but it's not just usually a unique product or service. It's usually somebody coming in with the shift in technology or the entire entrepreneur landscape landscape where something's happening and then somebody else is using new technology or new ways of doing things to then come in and build business on. Perfect example is blockchain, right? Blockchain didn't even exist before cryptocurrency first came out. But now that blockchain exists, now what happens is a lot of companies are getting a lot of funding from venture capitalists to use blockchain in new ways to do things that have never been done. So if you follow us on iTunes, we just recently had a guest. It was an awesome guest that was in blockchain technology. And what he did is they're revolutionizing the transportation industry. They're giving one place for people to go to see every stage of their products and getting shipped from one place to the other, which doesn't exist now. But blockchain gets them the ability to do this. So again, they're disrupting the travel, they're disrupting the transportation space because blockchain technology now exists. Before it existed, they couldn't do what they did. So those are just two examples, but it really comes down to not just a unique product or service. It typically rolls out that you're bringing out a problem that you couldn't have solved the way you're solving it if that technology wouldn't have been there. So just think about that as you're actually growing your company because it gives you something to look for. With a strong competitive advantage, obviously, you've got something unique. Maybe it is your team. Maybe it is your product. What other advantages you have to basically rise above the other people in your space or that may be getting into your space. So what else do they look for? Well, they're looking for opportunities, industries that they're familiarity with. Okay, so this is why when you see people invested in PayPal and Twitter or Facebook and Twitter or Facebook and Pinterest, it's because they're into technology. So again, a lot of them are investing into different sectors that you need to become, that they're basically familiar with. Why? Because they want to make an impact. They want to basically come in and they say, hey, look, I'm in financial services. I want to invest in other company in financial services because I can take my knowledge and help those companies grow fast to get a greater rate of return. And again, they're also looking for that chance to own a large percentage of that company so they can influence its direction with their actual experience. Okay, so what are the downsides? Well, venture capitalists can experience significant losses if their picks fail. And we talked about this. They expect 9 or 10 out of 10 to fail. However, these investors are typically very wealthy. So to them, it's risk and reward. To them, the way they look at this and manage this is that if they put $1 million into 3 different companies total, well, if 2 of them fail and 1 of them is a home run, then the 1 of them well pays for the losses. So these aren't people where this is all they do typically is invest in venture capital. They're usually retired. They've usually exited from businesses. They're usually multimillionaires or billionaires in a lot of different cases. Okay, they're often so wealthy that they can afford to take those risks associated with funding young and unproven companies. So we see this all the time in investing, right? When you go to talk to a financial planner, they're going to want to know how old you are because how old you are and how much you want to save determines the type of risk you're going to need to take on. Like if you're 18 and starting your investment portfolio, well, then a lot of people are going to say you should have more long-term conservative risk investments because you have plenty of time to earn the money that you need to earn. But if you're on a short track to success, you're going to have to take larger risks when you invest to be able to get those bigger wins to have enough money to retire on time. So again, what it really comes down to is that they can afford to take the risks knowing that a lot of companies will fail. Take the risk that lenders and credit issuers just as long as they won't, as long as you seem to have a great idea and a great management team or some kind of experience showing that you can actually run the business. So how are these firms put together? Well, a fund is created from pooled money typically. These funds come from the venture capital firm itself, wealthy people, pension funds, foundations, insurance carriers, corporate pension funds. Okay, so ultimately, in a lot of cases, you've got venture capitalist firms that are basically pulling together money from all of these different sources, and then they're pulling it together to actually lend to people like you. Okay, so all partners have part ownership of the fund. However, the VC firm controls where the fund is invested. So again, Everybody that's involved that's putting money in typically has part ownership of the firm, but the VC firm itself is the one that controls where the money goes. So investments are usually into businesses or ventures, which most banks or capital markets, which we talked about, would consider too risky for an investment. They want to be in the risky space. So the venture capital firms serves as the general partner. The insurance companies, pension funds, etc., are all limited partners. If you understand about anything about partnership, that'll make sense. If not, it's no big deal. It just kind of shows you how they all kind of rank in this venture. So how can venture capital investments be distributed? Well, venture capital fund managers are paid with management fees and carried interest. So depending on the VC firm, about 20% of the profits go to the company managing the private equity fund, while the rest go to the limited partners who invested into the fund. Okay, so that kind of gives you an idea of how they split the money up. And just the basic bottom line is that everybody has an interest here. Their investors have an interest. The owners of the firm also have an interest. They all have money at stake here in this process. So which roles will vary? The roles will vary, and there are usually three positions in these firms: associates, principals, and partners. So those are the three different positions of people that you're typically going to be dealing with when you're dealing with venture capital firms. So what does a venture capital associate do? Well, associates usually have experience in business consulting or finance. They sometimes have a degree in business. Associates often do more analytical work. They analyze business models, industry trends, and select subsections. They also work with companies in the firm's portfolio. They start off as junior associates and move to senior associate positions after a few years. So look, the benefit of working with venture capital firms is that you're not just getting them, you're getting their entire team, right? And you've heard this pitch before on Shark Tank where, Shark Tank says, look, you're getting a shark, but the reality is they oftentimes talk about how their team is going to help them. Our team will help with SEO, our team will help with online, our team will help with website distribution. These venture capitalist firms that people know that people need tech, they know that people need websites, they know that people need SEO and marketing help. So what they're doing is they're not just investing money and sending you on your way, they're helping in all these areas that you need help with, and associates are how they do that. They get people with knowledge, experience, or degrees in growing businesses, and then what they're basically doing is those people have knowledge that then helps you grow the business faster. So the venture capitalist is giving you the resources you need to be able to make the business successful. Now, a principal serves as a mid-level professional. They generally serve on the board of portfolio companies. They're often in charge of making, and what's that mean? Well, that means that they serve on the board of directors or advisors. Basically, they're working with the CEO or owner of the business to help guide decisions to make sure that their money is well spent. Okay, they're often in charge of making sure the companies in the VC firm's portfolio are operating smoothly, that everything is going okay, that you're hitting your metrics, that you're hitting your numbers, that you're hitting your goals. They're in charge of identifying investment opportunities for the firm, finding people that are worthy of investing in. These will be the people that you are actually pitching to when you're actually trying to get VC money. They also negotiate terms for both acquisition and exit. So again, then when it goes time to sell, they're the ones that are also working to negotiate those terms for your business to be purchased by another business or acquired, or to exit in some sort, such as going public. Okay, so principals can become partners. This depends on the returns they generated from the deals they make. If you got a principal that's crushing it with their portfolio, then obviously the VC firms are going to want them to have a chance to actually be one of the main top dogs, one of the principals, or one of the partners. So partners are mainly focused on identifying areas or specific businesses for investment. So what they're doing is they're coming in and maybe finding the random VC investment company or the company they want to invest in, but they're typically on the high level side of things. They're finding the areas to get into, the technologies to invest in. They may come to the mid-level and say, hey, look, I want to invest in blockchain technology. Find me the best options. I want to invest in the marijuana industry because that's exploding. So they're finding typically the areas, while again, the principals are the ones that are finding the deals. They also approve deals such as investments or exits, and partners sometimes sit on the board as well, in place of or alongside the actual principals as well. So in general, their role is to represent the VC firm, to do the highest level bidding funding for venture capitalists. So funding stages. Venture funding comes in stages and not all at once. Usually there are 6 different stages. You've heard some of these before. Let's break them down. Now, these are more or less correspond to the stages of a company's development. Okay, so seed capital is in the beginning, the seed stage, the startup stage, and the very beginning. Then startup is when the business is kind of getting up and running. Then growth, Series A, second round, or Series B, expansion, and bridge. Okay, so these are the 6 different areas that you will see when it comes to venture capital. So seed funding, this is the earliest round of financing needed to prove a new idea. Funding often comes from angel investors or lately equity crowdfunding. So seed funding is where it goes from concept to execution. It's where you're walking in with an idea and nothing other than a pitch deck of some slides to pitch your idea. Okay, it's nothing else. You have no infrastructure, you have no product, you have no company. You're just typically coming in with an idea. Now, in this case, angel investors are more predominant. This is the round that angel investors usually get involved in. They're investing 10 grand, 50 grand, small amounts. They don't want large percentage ownership in the company. They're not asking to sit on the board. What they're doing is they're like, hey, that's a pretty good idea. You sound like you are halfway smart. You got a pretty good idea. You sound like you know how to execute this. I'll give you 50 grand to see where this goes. Okay, that's what the seed round is. It's typically dominated by angel investors. Startup, early stage firm which need funding for their expenses from marketing and product development. So again, now we're to an idea. Now we're starting to execute and actually start to build a business. Now we're actually starting to create a product. Now we need money to pay people to build those products. We need money to be able to promote and market those products. That's what's happening in the startup phase. The growth or Series A, this is early sales and manufacturing funds. This is typically where VCs enter the picture. Okay, so Series A is essentially the first institutional round. Here's where most companies will have the most growth. So typically seed and startup is oftentimes dominated by angels. Again, these are the points where you're in some stage of starting the business with a concept, and they're going to give you some money just to see if you have what it takes to get this thing off the ground. Once you've proven it, once it's got off the ground, now you're selling. Now you're manufacturing. Now you've got a company. Now you've got employees. Now you've got a product. Now you're starting to market the product, produce the product. Okay, now you need to grow. You need to scale. This is where venture capitalists come in. And what's interesting about this phase is some of the best venture capitalists get advice from angel investors. So what happens is the angel investors are out there taking all the heavy risks with seed and startup rounds. And then what they're doing is they go to their venture capitalist buddies and they're like, hey, man, I invested in 10 companies, 9 failed. This one's a home run. This one's off to the races, but they're ready for a round A. They're out ready for a Series A. You know, can you back a Series A? And they'll bring in their venture capitalist friends. Venture capitalists are going to their angel investor networks and they're saying, hey, who do you have that's a hit? What should I look at that you have? So kind of look at this like angel investors are the ones you go to in the very beginning when you don't have a company up and running. They filter out the winners and losers and the people that are middle of the road, and they pass on the winners to the venture capitalists. And the venture capitalist comes in when it starts time to really start scaling and growing. Now, the second round or Series B, this is working capital for early stage companies which are selling product, but not yet turning a profit. So in this case, you're ready to grow. You're ready to start making sales, but you still haven't figured out everything where you're necessarily generating a profit. You could still be losing money even at this point where this happens. Expansion, okay? Mezzanine financing. It's expansive money for a newly profitable business. So the expansion phase is really the scaling phase. And I think I misspoke when I said scaling in the earlier stage. This is the scaling stage. This is where you have a product, you're selling it, you figured out how to sell it, you figured out that in fine-tune the product. Now you're scaling. You're ready to grow the actual company. Okay. Then we get into bridge financing, and a startup seeks funding between full venture capital rounds. The aim is to raise smaller amounts of money instead of a full round. Usually the existing investors will participate. So bridge financing is what happens in between every single one of these stages. It's what happens between second round. It's what happens between expansion, okay? So again, if you're an entrepreneur, you've heard these things before. You've heard You've heard the seed round. You've heard, you've heard bridge financing. You've probably heard mezzanine financing. You've heard Series A. These are terms you've heard. Here is how it actually breaks down. So venture capital excuse me, when it comes to bridge financing, for example, that's where somebody's going from working with angel investors, for example, in a startup phase, and they need a little bit of money to support them until they can get that Series A round. Maybe they don't have exactly what they need to get a Series A and they know it, and they need enough money to still produce that to get to the Series A round. Now, this could be very risky, bridge financing, because one, the company you invested in as a startup, the company that the actual initial, angel investors that put money in, they could be throwing good money after bad. The company could still not have enough worked out to ever even get a Series A, or they just need to fill that little gap to get a Series A. That's what bridge financing is to fill the gap between these rounds of funding. So VCs usually leave via a secondary sale, an IPO, or an acquisition. Again, that's what we're talking about, right? Somebody acquires you, a big company buys you, acquires you, a secondary sale, the company is sold, you go public, it's an IPO, right? So that's what happens. So if we look at Instagram like that, Instagram went with like less than 10 employees, sold for $1 billion. And a lot of people that had ownership interest in Instagram at the time, their investors were not happy about it. They wanted Instagram to hold out because they know that they could have made even more money. Okay, so again, what happens? It goes public. It got acquired. In that case, Facebook acquired them, or the company is basically just sold. Okay, so angel investors, venture capitalists, we talked a lot about this. Angels are not quite the same as venture capitalists. An angel investor would typically invest in early stage or startup companies, right? Those are those first two stages that we talked about of the process. They're the seed, they're the startup. Those are usually the ones investing there in those rounds in exchange for a 20-25% return on their investment. Angel investors tend to invest less and will also want less control, as we talked about, than venture capitalists actually do. Venture capital is a fairly new method of investing compared to angel investing. VCs invest in startups which they think will turn a profit. They often look for companies and industries they know. They're more amenable to higher risk investments. They invest more than angels do. Again, they'll invest millions. A lot of angel investors, believe it or not, only put 10 grand, 20 grand into a business. Some put 50 in. Most of the ones that put 50 in are not investors. They're investor networks. They're networks of a bunch of people that are pulling their money together. But a lot of these are pretty small investments, under 50 grand. A lot of venture capitalists is $500,000, $1 million or more. I mean, it's very common for it to be high 6, 7, 8 figures getting invested. And because of that, they want more ownership interest, right? They want more control. They want to sit on the board. They're going to start to push you for acquisition much sooner than angels will. So again, funding comes in well-defined stages, as we talked about. The venture capitalist wants a piece of the actual business, okay? And often a seat on the board of directors. So when it comes to angel investing, when it comes to venture capital, that's really how it breaks down. As angels are early stage, they're going to put less money in. They're going to want less control. Venture capitalists, you're going to get access to the firm's resources. They're going to be doing a lot more to help you succeed. They're going to want a seat at the table. They're going to want larger ownership stakes, as much as maybe 0.5% or half of the business or more of the money coming in. Angels are going to get involved when you have a concept, an idea, or just starting the business. Venture capitalist comes in when you start producing the product, making sales, even before you're profitable, all the way through the stages where you are highly profitable, all the way to the time that you exit. That really kind of gives you a breakdown of both of those as well. So that being said, hopefully you got a lot of good information out of today. We learned about what venture capital is, where it came from, its history, some of the biggest investors in venture capital. We talked about the difference between angel investors and venture capitalists. We talked about the different stages of investment, so you know what stage you may be in and the kind of funding that you're looking for in every single one of those stages as well. You find about how angel investors and venture capitalists really work together to find the right companies to invest in, that they're willing to take the higher risk, but again, they're hoping for a greater rate of return as well. So again, if you have any more questions on getting any kind of money, including venture capital, give us a ring, 877-600-2487 or info@creditsuite.com. If you like this, if this made sense, if this provided value, then go to the top right of our our page at creditsuite.com and check out our other social channels, like and subscribe. Okay, we're releasing content on Facebook, Instagram, and Twitter daily. On Facebook, we go live typically 1, 2, 3, 4 times a month where you can have an open question answer session. On iTunes, we release 2 episodes typically every single week, one an interview. For example, we just had an interview months ago where they talked to us all about creating a pitch deck for angel investors in venture capital, broke down that whole process where that's only available on places like iTunes. And even our YouTube channel has hundreds of different videos, even including one that I think we did, or a couple that we did not too long ago, that break down everything you need to know about angel investing as well. If you have any other questions along the way, 877-600-2487 or info@creditsuite.com. Don't forget to like and subscribe on YouTube. Don't forget to leave us a great review on iTunes. And don't forget to follow us on other channels to get even more information about getting credit and financing for your business. Next Tuesday at 1 o'clock on YouTube, we will have a session on what you need to know to build business credit. We're going to break down all the steps, and we'll go about an hour long. So I look forward to seeing you next Tuesday here on YouTube at 1 o'clock Eastern. Thanks, everybody. Have a great day.